Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about Starbucks. We will be reviewing the company's proxy statement to get a better idea of the executive compensation packages to see how the management is incentivized to make their decisions. We will be reviewing the company's key ratios, performing a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if we were to invest in Starbucks at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Starbucks.
Hey guys, let's start off by looking at Starbucks' 2020 proxy statement. We'll take a look at the executive compensation packages and see whether or not these incentives align with those of the shareholders. Over here, we can see the breakdown of the composition mix for the CEO and the named executive officers. We can see that only 7% of the CEO's compensation mix is made up of his base salary, and the rest is dependent on the targets that are being set forth by the board and whether or not those targets are being achieved. Now let's dive deeper into how this 13% of target annual incentive and the 80% the target long-term incentive is composed. Because if we look at the bigger picture, let's say if the CEO is making $100,000, only $7,000 is the base salary. $13,000 is based on the target annual incentive, and $80,000 is going to be the target long-term incentive. So it's important for us to dive deeper into the composition of these targets. Over here, Starbucks gives an idea of the annual incentive bonus plan and the composition for the 13% that made up the CEO's compensation package. We can see that 70% is the objective performance goals, where 40% is based on the adjusted net revenue, 60% is based on adjusted net operating income, and these adjusted numbers are definitely not something we want to see because they can be manipulated by the management to make it whatever they want to make it. In other words, they can say that, hey, let's take this cost out because it does not apply, or hey, let's add this not operational asset that we sold to this because it was tied to what I was doing, and so forth. So they're not GAAP numbers, and definitely something that can be played around by the management in order to meet their goals. So this was the makeup of the 13% of the CEO's compensation package, and the 80% comes from this formula, where it starts off by talking about the annual earnings per share performance targets averaged over 3 years times the 3-year total return to the shareholder versus the S&P 500. And then they add the time-based RSUs. RSUs are restricted stock units. Essentially, these are the stocks that vest after you have a certain amount of time or service with the company. We can see that the time-based RSUs are not very shareholder friendly because that's just telling the CEO that, hey, as long as you come to work every day, you're going to get this money. And that's on top of the base salary that the CEO is already getting. We can see that the performance metrics is specifically focusing on the earnings per share. And earnings per share is an accounting metric which can be manipulated by buying back shares when the earnings are low, and it's very superficial and only focuses on the income statement. Additionally, the total shareholder return is governed by the stock price of the company and the dividends that are being paid out to the shareholders. So this is the composition of the 80% of the incentive package that the CEO has. As we can see, the CEO and other executives are asked to focus specifically on the income statement since their compensation is tied to the top line, which is the revenue, the operating income, as well as the EPS, earnings per share. So not too much attention is being paid to the balance sheet or the cash flows that are coming in from the operations. Lastly, let's look at the rationale behind the CEO Kevin Johnson's compensation decision. Over here, it states that the CEO helped cross a key development milestone by opening more than 31,000 stores in over 80 markets worldwide. He also helped execute his operating goals, which resulted in 58% total shareholder return in fiscal year 2019. And Starbucks, for the first time in history, was able to cross a $100 billion market cap. Next, he led the company to net revenue growth of 7%. Again, revenue is the top line of the company, so it's not surprising that the more stores you open, the more revenue, the more sales you're going to make. After that, he delivered comparable store sales growth of 5%. The comparable store sales growth is a very subjective metric. It is not a GAAP metric. In other words, it's up to the management to decide which stores are considered comparable or not. If a store is being renovated, remodeled, or newly opened, management may decide to say that, hey, let's just disregard these stores from our equation because they don't give us a good idea or the sales may not be as good as the other stores. So it's up to the management to decide which stores to include and call them comparable. In short, the management can legally play around with these numbers since it's not a GAAP number, and they can exclude the stores that they think are not making as much money and eventually always come out ahead and show that, hey, they're growing. The CEO also returned $12 billion to the shareholders through a combination of share purchases and dividends. This is great because shareholders love to see companies that are buying back shares and paying dividends. However, it's important for us to see if in doing so the management is screwing up the balance sheet and taking on more debt just to pay out dividends and whatnot. So yes, it's a good thing, but we'll need to look at the key ratios to get a better idea of any gimmicks or tricks that the management is playing in order to meet its goals. And lastly, the CEO made some investments in digital, retail, and food technology, which would help the company in 2020 and beyond. Now that we have a better idea of the executive compensation packages and how the CEO is incentivized to make his decisions, let's take a look at the key ratios to see if there are any other parts of the financial statements that are being compromised in order to make sure that the income statement numbers look pretty. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at Starbucks. Under key ratios, the financials, the first item on the list is the revenue. The revenue is the top line of the company. This is the amount of money that the company makes from its sales. All the numbers here are going to be in millions of US dollars. In 2011, the revenue was about $11.7 billion. In 2019, it was about $26.5 billion. And for the year 2020, it was about $23.5 billion. We can see that the revenue did drop in the year 2020. This was primarily because of the COVID-19 pandemic and the store closures, which caused the sales to drop. However, if we look at the trend from 2011 through 2019, we can see that the revenue every year had been increasing. This shouldn't be surprising because as we saw, the management is incentivized to make sure that its top line number, its revenue keeps growing. That way they can collect a bigger paycheck, a fatter bonus at the end of the year. Next, looking at the operating income. The operating income is the amount of money that's left with the company once it has paid for the operating expenses and the cost of goods. We can see that back in 2011, the operating income was about $1.5 billion. For the year 2019, it was about $3.9 billion. And for the year 2020, it was about $1.5 billion. Similar to the revenue, the trend for the operating income from 2011 through 2019 has mostly been facing upwards. However, we can see that the growth in the operating income is not as significant as that of the revenue. This is evident when we look at the company's operating margin. The operating margin compares the company's operating income to that of its revenue. We can see that ever since 2016, the company's operating margin has been declining. This goes to show that the company's operating expenses as well as its cost of goods sold are getting larger, which is causing its operating margin to drop off. After that, looking at the net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for all the expenses, its interest on its debt obligations, taxes, and so forth. We can see that back in 2011, Starbucks' net income was about $1.2 billion. For the year 2019, it was about $3.6 billion, and for the year 2020, it was about $928 million. It's interesting to note that the trend that we see with the revenue and the operating income is absent with the net income. This shouldn't be surprising as the management is not asked to focus specifically on the net income number. It's good to see that over the past 10 years, the company has always made a net profit. Specifically in the year 2020, we can see that despite the pandemic, the company was profitable. Next is the earnings per share. The earnings per share is pretty much net income divided by the shares outstanding. As you may recall, earnings per share was one of the metrics that the management got graded on. We can see that over the past 10 years, the earnings per share has followed a similar trend as the net income. However, the earnings per share does portray a rosier picture because by buying back more shares, the company can inflate its earnings per share number. Next, looking at the dividends. We can see that back in 2011, Starbucks paid about 26 cents per share as dividend. And for the year 2020, it paid about $1.64 per share as dividend. We can see that every year for the past 10 years, Starbucks has been hiking its dividends. That is certainly a good sign and something we want to see as shareholders. We want to be invested in companies that are regularly paying and hiking its dividends. Next, looking at the payout ratio. The payout ratio compares the company's dividend to that of its income. We can see that over the past few years, the payout ratio has been rather high and to a point where the dividend payouts may not be sustainable in the long run. Next, looking at the shares outstanding, we can see that back in 2011, Starbucks had about 1.5 billion shares outstanding, and for the year 2020, it had about 1.1 billion shares outstanding. We can see that Starbucks aggressively started buying back its shares since 2017. This is certainly something that we want to see as shareholders. We want to see companies buying back its shares because by doing so, it increases the existing shareholders' ownership within the company. The stock buybacks goes hand in hand with the compensation package that the management has, as the more buybacks that the company does, the higher the compensation and the bonuses that the executives are going to get. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. We can see that back in 2011, the company had about $2.94 per share as its book value. And for the year 2020, it had about negative $7.35 per share. What this means is the company has more liabilities than it has its assets, and that has been the case since 2019. We can see that despite the fact that the company has more debt and is leveraged, the company decided to buy back its shares rather than pay down its debt. So again, the management is focused on the income statement, and by doing so, it is screwing up the company's balance sheet side of things. And if I were a shareholder, I would rather see the operations and the company being run to the point where the company would have little to no debt. But as we can see, the company is over leveraged and is deciding to buy back its shares rather than pay down its debt. So in a way, if you are a shareholder and the company were to liquidate today, which given the case with Starbucks, it is not likely. But if it were to liquidate today, you would not be getting a single penny from this company. Next, looking at the free cash flow. The free cash flow is what we get when we subtract the capital spending from the company's operating cash flow. We can see that back in 2011, the company's free cash flow was about $1.081 billion. For the year 2019, it was about $3.24 billion. And for the year 2020, it was about $114 million. Since the free cash flow for the year 2020 is an outlier, I will be using the free cash flow from the year 2011 through 2019 for my expected rate of return calculation, and I will be using the 2019 figure of $3,240 million for my discounted free cash flow DCF analysis. Next, looking at the profitability of the company, focusing on the net margin. The net margin compares the company's bottom line to its top line, so it's looking at the company's net income to its revenue. We can see that back in 2011, the net margin was about 10.65%. For the year 2019, it was about 13.58%. And for the year 2020, it was about 3.95%. What this means is in the year 2020, every $100 that Starbucks made from its sales, by the time it paid for its expenses, costs, interest on its debt obligations, taxes, it had $3.95 left as pure profit. And from those $3.95, it could either pay down its debt, buy back shares, pay dividends, and so forth. So the net margin gives us an idea of how much money is left at the end of the day. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. We can see that Starbucks' return on equity back in 2011 was about 31%, and for the year 2018 it was about 137%. We can see that Starbucks' return on equity for the past few years has been very inflated. This shouldn't be surprising because we saw that the book value, which is the same as shareholders' equity, is so tiny that when you divide a net income by a tiny number, you're undoubtedly going to get a big fat inflated return on equity number. We can see that for the year 2019 and 2020, we don't have a return on equity number because the equity portion is negative. Next is the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. We can see that the return on invested capital follows a similar trend as return on equity. Finally, looking at the interest coverage. The interest coverage gives us an idea of how many times can the company pay off its interest obligations using its income. Benjamin Graham, the father of value investing, preferred to only invest in securities that have an interest coverage of 5 times or greater. We can see that back in 2011, Starbucks' interest coverage was about 55 times. For the year 2019, it was about 15 times. And for the year 2020, it was about 4 times. Now let's look at the financial health of the company. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the current ratio to be greater than 1. We can see that back in 2011, the current ratio was about 1.83. And for the year 2020, it was about 1.06. We can see that over the past 10 years, the company's current ratio for the most part has been greater than 1. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except it disregards the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by the current liabilities. This number gives an idea of how dependent the company is on selling its inventory in order to maintain its liquidity. We can see that back in 2011, the company's quick ratio was about 1.17, and for the year 2020, it was about 0.82. We can see that over the past 10 years, the company's quick ratio has hovered between a low of 0.61 to a high of 1.86. And finally, looking at the financial leverage and the debt to equity ratio, we can see that the financial leverage as well as debt to equity ratio jumped up in 2018, and we don't have any meaningful ratios in 2019 and 2020 because the shareholder equity portion of it turned negative. Next, looking at the efficiency ratios, we can see that the first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day Starbucks recognizes its sales to the day it actually receives cash for its service rendered. We can see that back in 2011, the company's day sales outstanding was at 10.75 days, and for the year 2020, it was about 13.68 days. We can see that over the past 10 years, the day sales outstanding has stayed fairly consistent. Next, looking at the days inventory, this number gives an idea of how many days does Starbucks' products sit in its inventory before they're sold. We can see that back in 2011, Starbucks' products sat in its inventory for about 56 days, and for the year 2020, it was about 30 days. We can see that over the past 10 years, the days inventory number have been declining, and that is certainly something we want to see as it goes to show that the company is being efficient with its inventory. It is not having its inventory just sit around. It is making sure that it is being sold and a profit is being recognized on that inventory. Next, looking at the payables period, this number gives us an idea of how many days does Starbucks take to pay its suppliers. We can see that back in 2011, Starbucks took about 30 days to pay its suppliers, and for the year 2020, it was about 21 days. We can see that over the past 10 years, this payables period have been fairly consistent, hovering between 15 to 30 days. Finally, looking at the inventory turnover, this number gives us an idea of how many times does Starbucks go through its inventory in a calendar year. We can see that back in 2011, the inventory turnover was at 6.56 times, and for the year 2020, it's about 12 times. We can see that over the past 10 years, Starbucks has gone better at going through its inventory. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Starbucks' PE ratio is at 129.5, whereas S&P 500 is at 28.3. Next, the price to book. We can see that Starbucks does not have a meaningful price to book ratio because its book value was negative. S&P 500 on the other hand has price to book of 4.0. Next, the price to sales. Starbucks has a price to sales of 5.1, whereas S&P 500 is at 2.8. After that, looking at price to cash flow, Starbucks is at 75.7, whereas S&P 500 is at 16.5. And lastly, the dividend yield. Starbucks has a dividend yield of 1.6%, and S&P 500 has the same yield of 1.6%. We can see that on all these valuation metrics, Starbucks is clearly overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Starbucks. Over here I pasted Starbucks' 2019 free cash flow number, which is at $3,240 million. I'm using the annual growth rate of free cash flow to be 3%. What this means is I expect Starbucks' free cash flow to grow at 3% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate to be 2%. What this means is from the 10-year mark into perpetuity, I expect Starbucks' free cash flow to grow at 2%. Starbucks has 1,181 million shares outstanding and has a long-term debt of $14,660 million. I got this number from Starbucks' balance sheet. After taking all of these inputs into account, we get the intrinsic value to be about $24 per share. When we compare this intrinsic value to the current stock price of about $112 per share, we can see that the current stock price is trading at a premium of about 4.68 times. The way we calculate this intrinsic value is we look at what the free cash flows will be every year for the next 10 years. We sum up all those free cash flows, which come out to about $22.9 billion. Then we include the perpetuity component. In other words, we look at what the free cash flows will be from the 10-year mark into perpetuity. We sum up all those free cash flows to come up to the intrinsic value of about $43 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value to be about $24 per share. Now, if we disregard the perpetuity component, in other words, if we think that Starbucks is only going to grow for the next 10 years and then just stop, then we get the intrinsic value without the perpetuity component to be about $7 per share. Hey guys, now let's look at the expected rate of return calculation for Starbucks. Over here, I pasted the free cash flows that I got from Morningstar for the year 2011 through 2019. For the year 2020, as we know, it was an outlier, and we're using the average free cash flows from the year 2014 through 2019 for the year 2020's free cash flow. This is the yearly free cash flow trend that we get over the years. When we look at the future data and predictions, we're assuming that there's a 35% likelihood that Starbucks' free cash flow will grow at 3%. There's a 50% likelihood that its free cash flow will grow at 2%, and a 15% likelihood that its free cash flow will decline at 1%. This is the potential free cash flow raise that we get into the future. When we include the numbers of shares outstanding, which is at 1,181 million shares, at the current stock price of about $112 per share, we can expect to get a return of about 0.1%. What this means is if we were to purchase a share of Starbucks at the current stock price of about $112 per share, we can expect to get a return of about 0.1% on this investment. Hey guys, now let's wrap it all up. We looked at Starbucks' executive compensation packages and saw how the management is incentivized to make sure that the income statement numbers are pretty. They're also graded against some of the subjective metrics which are not GAAP related. We saw that the revenue as well as the operating income was increasing every year from 2011 through 2019, which was one of the things that the management was graded on. As far as the net income goes, we saw that there were a couple times when the net income dropped off and did not have the same kind of trend that the revenue and the operating income had. We saw that even though the dividends have been growing, such payout ratios are not sustainable in the long run, primarily because despite Starbucks having positive net income, the company's retained earnings had turned negative, which indicates that the company has been paying out a lot more dividends than its accumulated net income over the years. We saw that Starbucks' return on equity number was very inflated, primarily because the company had little to no equity. So when we compare income divided by a small equity number, we're bound to get a very inflated return on equity number. After that, when we looked at the current and the quick ratio, we saw that both the liquidity measures have been consistent over the past 10 years. However, when we looked at the company's financial leverage and debt to equity ratio, we saw that the company has taken on a lot more debt over the past couple of years, causing its book value to turn negative. In other words, the company has more liabilities than it has in assets. After that, when we looked at the efficiency ratios, we saw that the company has been consistent with its efficiency over the past 10 years. Moreover, its inventory turnover number has increased, which indicates that the company has gone better at going through its inventory in a calendar year. When we compared Starbucks to the S&P 500, we saw that on almost all the valuation metrics, Starbucks was overvalued to the S&P 500. After that, when we performed the discounted free cash flow DCF analysis, we found out that the intrinsic value of Starbucks comes out to about $24 per share, which, when we compare to the current stock price of about $102 per share, would indicate that the current stock is trading at about 5 times its intrinsic value. Next, we found out that if we were to invest in Starbucks at the current stock price of about $102.33 per share, we can expect to get a return of about 0.1% on this investment. So what all of this means is Starbucks is an overvalued security, and that does not mean that the stock price cannot go higher. It can certainly go to $150, $200 per share in the near future. However, this security lacks the margin of safety and the return that we expect with any investment. We saw that the management is incentivized to focus on almost all the metrics that are on the income statement, and in doing so, it has screwed up the company's balance sheet. The company has taken on a lot more debt, especially this past year, when it ended up buying shares rather than paying down some of its debt. Hey guys, that is all I have for you this week. Hopefully you found this video on Starbucks interesting. If you do like this content, please do like, share, comment, and subscribe to my channel. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.